really the goal is not money. Money is a tool. Freedom is the goal. And you get freedom by choice.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in.
All right, welcome back, Freedom Point Podcast listeners. Thanks again for jumping into another episode. I've got another amazing guest. I know every one of my guests are amazing, but this one's very special to me. So very glad to have with me on the show today, Justin Moy. Justin, welcome to the show.
Jeremy, man, I'm so excited. You guys have been pumping out some quality episodes. You guys hit the ground running getting this thing going.
Well, I really appreciate that, and I'll send you a $5 bill after the show for giving us a fancy little shout out there. But yeah, I wanted to give my audience just a brief background on Justin, and obviously I'm going to kind of have you do the lion's share of telling us about your background. But Justin is the managing partner of the President's Club Investors organization, which I'm really excited to hear more about that because I love the words President's Club, which most people that listen to this podcast are President's Club qualifiers in their own respect. So appreciate that name. And then Justin also hosts his own podcast, which I've listened to numerous times. I've recommended that potential investors also check out your podcast as well. You provide some amazing content, and the name of that podcast is Passive Real Estate Strategies. Again, Justin Moy, M-O-Y. If you're listening to this podcast, please do head over there and check out Justin's podcast. So without further ado, I want you to provide whatever value you're able to provide to the listening audience today. Again, Thank you. Welcome to the show, and let us know more about Justin and what you've got going on.
Yeah, thank you. Well, man, after I send you back that $5 bill for that kind of shout out, we're just passing by the passive income here, man. I love it. So I'm managing partner, like you said. President's Club Investors is our firm, our syndication firm. And just as the name implies, and like we were talking about a little bit before we started recording, me and you are both recovering sales guys. And there's a lot of sales professionals out there. And when I was in sales, I remember being very limited in my financial education. All your training and all your coaching is about making more money, which is fantastic. You should max that out first. You should invest in yourself first and foremost, no matter what industry you're in, but especially if you're in sales. And once we made all that money, I realized I didn't really know what to do with it. And one big problem, and there's a few that I'll talk about, but a big problem that is unique to sales professionals that other industries just don't experience to the level that we do is that enormous creep up of burnout. And all those President's Club winners, all those top producers, you all know it. You all know you work 60 plus hours a week to make those numbers happen. And just like you and I'm sure you love it right now, at least. And I was the same way. When I was 18, I started selling houses. I actually didn't sell a single house until I was 6 months into the role. I made $0 in 6 months. And then all of a sudden I made that one final call after I decided I was going to quit. That ended up being my first listing, my first sale, $60,000 net commission to me. So I caught the sales bug right after that. And I was selling and I was selling and I was selling and I was loving the grind and loving the hustle. But one day, I don't remember what it was, but I just realized like, man, I can't do this much longer. I definitely can't see myself doing this another 40 years, 50 years. So I started looking for different ways, and investing was that way. Now, anybody who goes down the rabbit hole of investing, if you're unimpressed by stocks, that's normal. It doesn't really provide the things that we provide, and it doesn't fill a lot of the gaps that sales professionals have. And so now at President's Club Investors, our goal is to help sales professionals retire within 10 years by replacing their active income with passive income. And that's really the ultimate goal. That's why I get up every morning.
Amen to that. So that is an incredibly good hook. So now that anybody who's listening to this at this point wants to know how they're going to be able to make that happen, right? And
Yeah.
obviously that we have a lot of folks that join this podcast that aren't necessarily busy sales professionals. They might be small
Mhm.
business owners, they
Yeah.
might be engineers, doctors, et cetera. But before we jump into how exactly, you position that strategy
Mhm.
for investors, I obviously wanted to give you a huge shout out to the fact that you're exactly right. When I was in my 20s, I busted it day after day after day,
Mhm.
consistently putting in 60 to 70 hours a week. Why?
Yeah.
Because I was hungry to be the number one guy, right? I
Mhm.
was hungry to be the guy that was chasing after the carrot, that was crushing his numbers, month in, month out, year in, year out. The
Mhm.
challenge is as we get older, and I'm in my 40s now, I have 4 children, your priorities out of necessity need to start to change. Okay.
Yeah.
If they didn't, then I wouldn't be the guy showing up to my kids' hockey games. Okay. I wouldn't
Mhm.
be the guy that's showing up on the first day of kindergarten. I wouldn't be that guy. Why? Because I'm so focused on my day job. And then as your kids get older, uh, you continue to be spread even more thin. You start thinking
Yeah.
about the fact that I've got aging parents now. I want to spend
Yep.
time with them in some of their later days of their lives, right? I maybe have a something that I want to give back to society, whether that be
Mhm.
volunteering in a church environment or other nonprofit organization. So you start to really think about those things. So for me, it's less about wanting to completely replace my hard earned income with passive income. And it's more
Mhm.
about replacing it so that I can choose to do something different with my time as I
Yes.
get older. Does that make sense?
Yeah, that's exactly what it is. And what I like to tell people is every time you invest, you slowly reduce your dependency. So, passive income is a great thing to pursue. I think most people, if you were 100% passive, if you hit the lottery today and never had to work a day in your life, I bet there's almost nobody listening who would truly do nothing. Right? You would find something. You'd open a business. You'd start a charity. A nonprofit. You would do something with your time. But it's about reducing that dependency until you're making the decisions. Really, the goal is not money. Money is a tool. Freedom is the goal, and you get freedom
Mhm.
by choice. So
Yeah,
yes, I
absolutely.
totally agree. People, and if you're listening to this, you're saying, "Man, I don't want to retire. I believe you." But for when I was looking into the future, I was seeing similar things to you. Man, my personal relationships, I can't keep this up. And if I want to
Yep.
make the kind of money I'm making, I kind of have to keep this pace up. So how can I complement these things and then replace? So yeah, we're
Yeah.
in exact same path there. And most people go through that. And if you're not feeling that way, maybe in a couple of years you do. And as priorities change, the best time to do things was 10 years ago. The second best time to think about them is now.
Yeah, that's right. So here's another conundrum that I have, and maybe
Yeah.
you kind of feel the same way as me. But for 2 decades, I was blessed to be able to participate, in the company sponsored retirement plan, maxed out the
Yeah.
401k, any extra commission checks that I had, I would, try to find the next Tesla stock,
Yeah.
Facebook stock. I'd go after the ones that paid the dividends, and I'd go after the ones that I was hoping would go from $2 a share to $200 a share, right?
Yeah.
Did the mutual funds, did the bonds. I did all these kind of things, right? Because that's what the system told me to do. That makes sense.
Yep.
The challenge that I had is about 10 years ago, I started to look at the trajectory of what those investments would look like. And in correlation to also what the inflationary rate was at the time,
Mhm.
in addition to how much, cash flow I need in order to be able to, live the lifestyle that I have today and what that
Yeah.
lifestyle, how I want it to look in the future. And I looked at myself and I said, this is not going to work. I said, I had to
Mhm.
do something different. Right. And so
Yep.
that's really what kind of launched me or propelled me into getting into the passive real estate game for some of the obvious reasons. So I'm going to turn it back to you and have you tell us. So when you're talking to a potential investor or one of your investors, what are some of the main reasons why somebody should consider diversifying outside of institutional grade investments and into
Yeah.
private placement?
Yeah. So I I love finance and I've done a ton of research on these things. The first thing I'll say to that is the Charles Schwabs of the world are phenomenal marketing machines. They're phenomenal marketing machines. Now, when I've always loved finances and I've always loved sales. So naturally that brought me to, I should be a financial advisor, work at one of the big companies there, went through that process. And one thing that bugged me is I realized that they never train you on investing. It's always about business generation. And what do they never do on a long-term basis? They don't outperform the public markets. They don't outperform those index funds. So on one hand, we know what we'll get in one scenario. It's whatever the index funds are going to return. They say it's an average of 8% per year. It's not. Once you factor in taxes and fees, and even before you factor in inflation, it's closer to 4 to 6%. The way you get to 8% is by manipulating the dates. If you pull up that returns average on the annual returns of the S&P 500, you look at the 80s and the 90s, Jeremy, you couldn't miss. There were 13 years out of those 20-year period of double-digit returns. 13 out of 20 years, double-digit returns. 3 years of small single-digit loss. You were an idiot if you were not pushing all your cash into the stock market. And because of that, that's what our parents told us. Man, this stock market thing, you can't lose. And inflation was still holding at, 1.5%, 2%. But since the 2000s, it's a roller coaster out there.
And then the year 2000 happened.
Mm-hmm. Yeah. And then you're up 30%, you're down 25, you're down 8, you're up 1. You can't keep up with the thing. And inflation's coming in and eating away at that return at a higher rate than we've ever seen, ever.
Yeah. Yeah.
So just like you said, you look at this trajectory, and the reason why I get up every morning to tell people about this thing is because if you just see what I'm seeing, and it's numbers, it's not my opinion, it's numbers. You look around, your Social Security is running out. France can no longer afford to retire their people. They're at 60, they went up to 62, and they rioted over it. In America, we're going through the same thing. People just aren't aware of it.
Yeah.
So if you think that you don't need to adjust your investing strategy based on modern times and modern availability, the only reason why people were not doing a lot of syndications and private placement funds before is because it was a good old boys network back then. You had to be the hedge fund. You had to be the family office. You had to be born into a family that had these connections. But now with the internet, it's widely available.
I had this conversation with my son the other day. Mm-hmm. We talked about inflation. Okay. That topic alone. I said, Jack, when I was 30 years ago, when I was your age, which like 14. Okay. I remember I could go to McDonald's and I could get a number 2, which was the 2 cheeseburger, the pop and the fry for $2.99. And I said, Jack, you've recently gone to McDonald's. You like the number 2 as well. What did you pay for that? $8.50.
Yep.
I'm going, okay. So what used to cost $3 just 30 years ago is now $8.50, right?
Yep.
So my question back to you is this: since inflation is obviously a permanent fixture within our society today, why is real estate investing on the passive side or active side? Why is it a hedge against inflation?
Yep. Hard assets are a hedge against inflation. Physical, tangible assets. The reason we get inflation, and inflation, a little bit of inflation is actually good for the economy. And I'll dive into that in a minute. But when you have fiat currency, meaning our money is no longer backed by anything, everybody who was pretty financially savvy, once in the 70s when America got taken off the gold standard, everybody who was pretty financially savvy knew savers are in trouble. We have to start buying hard assets, things like real estate, things like gold, things that take effort to produce. You got to build the housing. You got to mine the gold and shape it. You have to do these things. You can't just create it. Because what happens is the government essentially wanted to be able to create more money because we had debts we couldn't pay. We had wars we had to fund at the times. And whether those are the right decisions or not is neither here nor there. But we wanted to do it. The Fed wanted the power to print more money. So they removed the backing and they created fiat currency. Now, when it comes to inflation, since you cannot just create more housing, since you cannot just create more gold and create more physical things, those go up in value with inflation. If you look at rents in relation to inflation, they go hand in hand. And whether you believe it's fair or not, or whether you think housing's too expensive, not expensive, whatever your opinion is, it doesn't matter. What happens is when inflation increases, housing increases as well, rent increase. And yes, expenses increase too, but not at the same pace as rents. So you have this great vehicle that grows along with inflation. Everybody's seen, if you're on social media enough, you'll see that old flyer of a house in 1950. It's like, $4,000 for a 2-bedroom home. Same 2-bedroom home is $2 million. So this asset is growing along with it. So it hedges inflation beautifully. And inflation is the number one silent killer of your wealth. The number one.
Yeah. And so is wage growth, which is why then those people that are renting, why they're also able to pay, $200, $300, $400, $500 more for that same 2-bedroom, 1-bath unit, because their wages are also increasing along with inflation. So thank you for that.
Yeah. I mean, I actually saw this video. It was a little case study. Speaking of inflation, and now what's really cool is you have all these apps to order like your groceries and stuff like that from. And what's really cool about those is it saves all your transactions. And so somebody, and they did this on TikTok, so, take it with a grain of salt, but somebody said, hey, I've been doing the same grocery delivery service for like 2-3 years. They compared their receipts from 2 years ago and they built out a similar cart to what it is today. And it was a 27% difference.
Wow.
27%.
Yeah.
So your wages aren't growing by 27%. Your investments damn near need to. You don't have the option anymore. So again, is it fair to the American people? I don't think so, but this is the game that we're in and you got to understand the rules and play the game. I get fired up about this kind of stuff. I mean, it's a silent wealth killer. It's a tax on the working class, really, if you think about it. So you really have to be hyper aware of how your investments do during inflation.
Yeah. So now you've got that investor out there that you're having a conversation with. How can that busy sales professional, that top sales professional, how can they replace their dependence on the W-2 over a 10-year period?
Yeah. So you have to get there's really 2 crucial steps in the process. And this is such great timing. Yesterday, I actually gave a presentation, 6 steps to 6 figures in passive income. Most successful presentation I've given, I only had 8% of people not stay the entire presentation time.
For the people that aren't watching this right now, Justin Moy is like one of the most handsome guys I've ever seen. So that could also be a reason why.
I appreciate, man, you're going to make more money on this. Got to send you another $5 as a $10 compliment. So there's really 2 enormous steps and you have to get them right. To do this fast, you have to get these right. A lot of people, when they invest, again, they think of like the stock market, they think of that linear growth, that maybe 8%, 9%, whatever it's going to do. If you do the math behind replacing your income with passive income and your benchmark is at 8 to 9%, you're doomed. And if your benchmark is that 4% rule that the Charles Schwabs of the world advertise to you, then you're completely screwed. So what you have to do, and what I tell my people is, most likely, unless you inherited a ton of money, you're going to need to take what investable cash you have and multiply it. One of my favorite sayings from one of my mentors is amateurs add, professionals multiply. When you look at things like value add real estate right now has by far the highest multiples on your efforts. So me and you know about cap rates. So cap rates are how commercial real estate is priced. Almost anything in income producing real estate is priced. A 7% cap rate is pretty conservative, right? In a growth market, 7%, hell yeah, you're buying that.
Right.
That means, without getting into the weeds of the math, that means for every $1 of increase of net income you create, you get $14 back in equity. A 14x return on your efforts. To benchmark you to something else in the private sector, businesses. A healthy business, and I've asked multiple business brokers this, I've asked multiple family offices this, they all say about the same stuff. If you're going to sell a healthy business, you get about $4 for every $1 of net income that you create.
Sure.
So on one hand, you have a 4x multiple, on another, you have a 14. So when you look at value add real estate, it is very feasible to double your investments every about 5 years or so. And you've invested in a lot of deals. I'm sure that's kind of a timeline that you've seen. So when you look at that and you start investing consistently year after year after year, and that investment starts to double in 5 years, and the next one doubles in another 5 years, and the next one, by the end of the day, you have a really large pot of investable cash that you can flip into higher cash flowing debt products or triple net leases, stuff that's higher cash flow. And because along the way, you've leveraged depreciation to offset a lot of your gains, a lot of times it's tax free.
Mm-hmm.
Not tax advice, but you got to sit down with your consultant on that. But you can play the game of taxes here. The ultra wealthy invest in real estate for appreciation and depreciation.
What other investment option do you have out there where you can take advantage of both appreciation and depreciation at the same time? It almost seems too good to be true.
Yeah, it does. And, you have to think about the reason why these tax benefits exist as well is because the public sector, the government needs you to invest. Our economy relies on the movement of money. And quite frankly, when real estate trades hands, a lot of people get paid. And that's great for the economy. There's really nothing else the Fed can do to stimulate that type of growth. So you'll see what the country needs. You'll see different tax benefits follow. Oil and gas right now, crushing it in their tax benefits. Some of the best ones they're introducing because they need more investment in that sector. So not only is it great for you, but when you look at these things and you understand the tax code is helping you nudge where the government needs money, it's a great thing to do for the country as well.
You brought up value add. I know that kind of the flavor of the month or the shiny new object that's been going around in the real estate investing space is the build to rent. Do you have any opinions on, what the future is? I know every market is different in terms of what's going to work strategically in that area, but any thoughts on the build to rent space?
Yeah, it is the shiny new object, and rightfully so, because in the beginning, you're seeing these huge returns for it. And different asset classes, they go through a similar lifestyle, right? Or life cycles. So if something's brand new, the returns need to be very high because the risk is higher. Now it's becoming more mainstream to do these things. And you have investors that have never touched development now investing in these, they're throwing out these terms, shovel ready, vertical ready, they don't even know what it means. So it can be very lucrative for you, but you have to look at what is the person's experience in that asset class. If you've never done a build to rent, I don't care if you've done 1,000 value add transactions, you will never get my money. It's just the way that it is. And that doesn't just go for build to rent, that goes for anything. There's some great partners that we have that are getting into the LIHTC space, low income housing tax credit space. They're phenomenal partners. They're great people and they're great friends. I'm not giving you my money. You got to do at least, 5 or 6 of those, to kind of get your feet under you, because there's always growing pains there. Yeah. So if you have a partner who you can really trust there, they can be fantastic. But when it's the hot new thing, make sure that they're not experimenting with your money.
Yeah. The thing that I had a hard time with, and I've had a number of build to rent deals come across my desk that I've evaluated as a limited partner investor. And the last few that I've seen, I've passed on. The average equity multiple on those deals, was advertised to be a 2.5 to 3x. The problem is the hold period was 7 to 10 years, and they didn't start cash flowing until Q1, Q2 of 2026. Whereas in the value add space, we typically will see an equity multiple around 2. We typically see that hold period being anywhere from 3 to 5 years. We typically see some of those deals, depending upon the strategy, of the sponsor, we might see deals starting to produce, cash on cash returns, in that 4 to 6%, right away, year one, quarter one, month one. Right. So that's kind of the reason why I've personally not really jumped on the build to rent bandwagon, but I can definitely see that it could be a potential, good opportunity for folks, especially, given the fact that a lot of transaction volume's down, that value add space. It gives people a place to park their money. I'm just not a real big fan of locking up my cash for 7 to 10 years, at a 2.5x equity multiple when, I can get a 2x equity multiple in half the time.
Yeah, I agree. And it's a great point because it lacks the cash flow, which I call a defensive metric. So again, when you're really focusing on growing, is the 5 to 6 or the 4 to 6% cash flow on a $50,000, $100,000 investment going to change your life? No. You're a top producer, you're making 400 or 500 grand a year. You probably won't even notice that, but it's a defensive metric up to that point. Cash flow helps you weather storms. So when you don't have cash flow, you're going all growth. You can't weather the storm. And that's really good because for us, everything that we invest in has to have some type of cash flow to it. I don't care what it is. It has to pay. If we invest in it today, it pays us tomorrow.
Yep.
And it's non-negotiable for us. And things happen, right? But project it. And one of the reasons is when you're in sales, your months are not always even, right? So some months you might want that extra kicker to come in and that cash flow to come in. And, if you're a bad quarter away from having to kick rocks and find a new job, you want that defensive metric. That's when those things start to really matter. So even if the cash flow is not a big part of the overall return of the deal that we're looking at, I do need to see some type of cash flow.
Yeah, absolutely. I'm the same way. I'm a big cash flow plus equity, investor. Yeah. I'm in my mid 40s and that kind of strategy has worked for me. I love the value add space because I'm not banking on natural appreciation. If I know, like, and trust the operator, it's rinse and repeat for them. They've got a great, team behind them. They've been through, this kind of, scenario recession, activity before. I'm comfortable with taking a little bit greater risk to get a potentially greater reward from it. But I can certainly see as investors, maybe get a little bit older in their 60s and 70s, they might be more focused on, the cash flow, that an investment could produce as opposed to that potential equity upside that they might get, in 5 years, right?
Or when they're retiring at 30 or 40, if they use our methods, man.
Use the methods. That's right.
Yeah.
I want to pivot to something here, if you don't mind. Have you personally, just in your kind of, transition from, crushing your sales job to now kind of pivoting into, real estate on more of the education side of the investors, have you personally encountered any, headwinds? Have you made any mistakes that you've maybe learned from? What kind of defines, maybe kind of the ugly side of Justin?
Anybody who says they haven't made mistakes is either just lying or they just can't think of them on the spot. But we've made mistakes in transitioning. Now, luckily for us, our mistakes were done with our own money. When you're in sales, and this is one of the reasons why I love salespeople, and it's just, I think it's something in our blood. It's just different. Is we tend to feel like we can take on the world, and that's true to an extent. And so when it came to our first investment, we were going to take the whole thing down ourselves. Me and at the time it was two JV partners.
So this is an active real estate deal that you and a few buddies decided you're going to throw a bunch of cash at this thing, and you guys are going to figure it out later.
Yeah, exactly, exactly. And we did figure it out. We made decent money. But if we would have partnered, we would have, oh my God, we would have slam dunked it, home ran it. It would have been a banger of a deal. So we were okay because there was so much meat on that deal that we could afford to make a lot of mistakes, and we did. But if we would have partnered, we would have easily probably 3x the return that we ended up getting. So when you go from single family to commercial, one of the biggest things that I noticed being so intimately involved with both sides is how prominent teams are on the commercial space. Even in the broker space, you have teams. You have in the investment space, you have teams. It's very, very, very hard to do all this stuff yourself, or even with a small kind of band of friends or band of brothers, right, to doing this stuff yourself. You got to have real solid professional teams, people who have been there and done that, people who have worked these assets, know the banks, have the connections. You've got to plug into a system like that. Very hard to be successful without it. So when you're going into some bigger projects like this, look for teams, pay for mentorships, whether you pay them in dollars or you pay them in equity on your deals, it will pay off, and the education you get will be unmatched. So a big mistake is, feeling like I could take what I learned in sales and I was really good at this and I could figure stuff out, and thinking that applied everywhere. It helps. But it was, luckily we made some good money on it, but it could have been, like I said, a real banger if we did.
Well, I know top sales professionals don't really need the support of anybody else because they've all figured it out. They're on the top of their game, that kind of thing. They don't need the support of other people. But I think of the word leverage, right? Really, what you needed at that time is you needed to leverage someone else's experience, somebody else's time, and somebody else's network, right? Which is really why people are attracted to Justin and myself in the real estate investing space is because we've put in the reps, we have the experience, we've put in the time, and we certainly have a network, right? And so for busy professionals out there and high income salespeople, they might not have the time to find the education. They might not have time to build on a network. They might not have the experience necessary in order to evaluate one pro forma against another pro forma, right? So that kind of bleeds into my next question for you, and that is, what are some of the mistakes that you're seeing newer investors making?
Man, and so some mistakes that some newer investors make is, first thing is, you do want to do some research. You do want to know what you're getting yourself into. You do want to understand the asset and the business plan. And here's what I always say. You want to understand the non-tangibles of the deal. The non-tangibles, and it's hard to give an example, but if you look at any deal right now, when you advertise, when I advertise, Joe down the street, it doesn't matter. You're generally going to see the same numbers, the same tangibles, right? A 2x equity multiple, about 5 years, let's say, there'll be, 5 to 6% average cash flow per year. The IRR 15 to 20%. It's all the tangibles are the same. The numbers are the same. When you're looking at a deal, what's really going to make the deal different is the intangibles. And that could be something like, this is a property we're buying from a 15-year owner who passed away. The kids got it, thought they could run it for a year, ran it into the ground, and now we're saving the deal from them. Like, that's an untangible. That is something that you could set this property up to be really, really successful. Underwriting models and projections and, all that stuff, you can only tweak it so much. What are the non-tangibles of the deal that make it really special? Maybe it's that, hey, this is the deal now where we get to hit some scale. We have 60 units in this right next door. This 40 unit makes 100, and now we hit employment scale with the management. There's intangibles of great deals, and you want to find out what those are, because all the packages look the same, the numbers look the same, the projections, they're market rate projections, right? Nobody advertises a deal that they don't believe will hit market rate projections. But what are the untangibles of the deal that really make it special?
Yeah, absolutely. It's also a great story to tell, investors as well, in terms of what are some of those untangible, non-pro forma, type pieces of information that really will make this ultimately a good deal. My next kind of follow-up question there is, what are one or two, assumptions that you see, sponsors really getting maybe a little bit too aggressive on, in the pro forma? Might you share a couple of those with us?
Yeah. The two biggest levers that a sponsor can pull if they really want to beautify their deal is organic rent growth percentage and their exit cap rate. So organic rent growth percentage, some people got a little bit crazy when rents were 17, 18% in some markets. I think Phoenix hit like 24 at some point. I mean, it was ridiculous, right? I need to see that to be normalized. 3% is fine. You can maybe get to 5, but I don't love to see much more than that. So if I really want to make a deal look better, I can manipulate that, because that number builds on itself, right? If the average rents in a building are $1,000 and I project a 5-year increase or 5% increase per year, year 2 builds off of year 1, then builds in year 3, then builds. It's something that continues to grow. So that's something, if you miss on that, you can miss pretty wide. And your exit cap rate. Can this sell at a 5 cap or a 5.5 cap in 5 years? Maybe. I don't know. Will the Fed increase interest rates 11 times in 12 months that you want to sell the property? I don't know. Nobody knows. But what is a fair market cap rate that I believe this location gets? The more desirable a location, the lower the cap rate. In Phoenix right now, you might see some 5s, some below 5s people are buying in because it's growing so rapidly. If it's a growing city, I'm willing to pay a little bit more and accept a lower cap rate. If it's a tertiary market, I need to see that be a little bit higher. But those are the two levers that you can pull just to really make all the cells turn green in your underwriting model. So I would be hyper cognizant of those.
Yeah, those are two great ones. The organic rent growth. I'm a big fan of, sponsors presenting to their investors, a very, very conservative organic rent growth, amount. And then second to that, the whole idea of the exit cap rate has always been a bit of a challenge for me, because I mean, let's be honest, nobody has a crystal ball. Do you really
Yeah.
know what the exit cap rate is going to be in 5 years from now? There's no
Hmm.
way. So I'm
Yeah.
a big fan of sponsors really kind of providing, their investors with kind of a best case, worst case, in
Yeah.
5 years or 3 years or whatever that projected hold period is.
Hmm.
This is kind of a best case, worst case, based upon what we believe that exit cap rate could be to show
Yeah.
investors that, at a 3.5 cap, we might produce a 22%, IRR, but at a five and
Yep.
a half cap, it might be, 14, IRR. So,
Yeah.
yeah, appreciate you
Yeah.
kind of sharing that with me. You have anything more to add to that before?
Yeah. Yeah. I was gonna say, those stress tests are really good, and it gives you a full scope. And if you're always going to look at all the negative, you might scare yourself off. If you're always looking at all the bright side, you might get burned on one or two. So you have to find out where you're balanced. And if you feel like, hey, the exit cap might be a little aggressive, but man, I think they were really conservative on the rents, and they kind of padded their expenses a lot. So nobody turns all the levers one way or the other. Like, no operator out there has 100% everything is rock bottom conservative. Nobody does that. Likewise, nobody flips the switches the other way and says, hey, we're all the way to the wall aggressive here. So there's levers that can be pulled. So find out what you're comfortable with. And really, where you get in trouble is your debt. So what if cap rates cannot, we underwrote a 5, they're 7 in 5 years. Okay, well, what does the debt look like? Can we extend? Is it a 7 year and we can kind of ride this wave out and see if cap rates drop in a couple of years? So the debt is going to be the number one killer of your deals. You want to make sure that that has some flexibility in it, so that if the market isn't where you want it to be in that 5 year period, which nobody can really predict, you have some rope to weather that storm.
Yeah, I see a lot of sponsors right now, unfortunately, banking on doing cash out refinances in 2 to 3 years from now.
Yeah.
Hoping that interest rates go down, and maybe they will. I hope they do, right?
Mhm.
But maybe they won't.
I know. That's a tough maybe. It's tough when not everything's in your control totally, but when something that big is not in your control, it's a lot of sweaty nights.
Yeah, for sure. Well, what are a couple of educational resources that you recommend to investors?
Yeah, podcasting is a great one. This podcast is fantastic. I've listened to a couple episodes. You do a really, really good job, and you have great experience, passive and active. Of course, I think my podcast is good, but this one's fantastic as well. If you want to learn more about retiring within 10 years, you can go to, we have a landing page for it. It's called retirewithin10bundle.com. 10 is the number, so 10. There you'll get a retire in the intent calculator. You put in some basic plugins about yourself, see how fast you can replace your income with passive income. You get an ebook, The Top Secret Investing Strategy for Sales Professionals. It's going to dive into what we talked about. We went pretty surface level on this. It's going to take a deep dive into all we talked about, specifically for sales guys and girls. So it's a great resource there. And the third is a secret bonus gift that I'm going to keep on the low on it. But this gift is going to help mitigate risk in your investments, and it's going to save you dozens of hours down the road as you start investing. So retirewithin10bundle.com. If that's your goal, if you really want to push that retirement, you want to replace your income with passive income, you want to reduce your dependency on that active income slowly and surely till you can replace it, that's going to be the best place for you.
That's great. Thank you for sharing that. And listening audience, we will share that information in our show notes as well. Justin, what are one or two ways that you use your talents to give back?
Yeah, I am very, very passionate about things that have to do with kids. I think, kids don't really pick a lot of the scenarios that they're in. It's very hard to, you just can't pick those things. And it's hard to pivot when you're a little kid. And so much of your dependency is on adults or parents that maybe aren't totally there for you. So anything that has to do with hunger and has to do with kids, school drives, I'm a huge fan of. I think that is an outlet that is missed a lot. If a lot of kids, unfortunately, they don't like their lives at home, and so they go to school, and that's kind of where they feel most comfortable. And a lot of times, maybe they don't have the equipment to succeed there. So I think there's a lot of potential there in helping kids be equipped well for school and being fed. A lot of programs out there that look to get meals to kids, whether they're in the cities or in areas that are food deserts. It's just not something that they can control, I think. And I think everybody deserves a chance. And if you're at least fed and you're at least housed, and I can at least help you with some school supplies and do that, I feel like I've done as much as I can to really set that person up. So, not everybody has the chances that we've had, and everybody's story is a little bit different. So I think if you can look down the ladder and help pull people up as you climb, that's one of the best traits that people can have.
Yeah. Thank you for sharing that, Justin. And what's the next item on Justin's bucket list?
Yeah, well, it's coming up here at the end of the year. We are going to Thailand. So I'm a big traveler. I love traveling. I studied abroad in college and totally caught the travel bug. And then I was supposed to go to Thailand before COVID hit. And I was so close to it that if I would have gone on my trip then, I would have been stranded in Thailand for like 6 months or 9 months or whatever it was. It was pretty, I didn't know it was that severe as it was. So we finally got the trip booked up. First time in Asia. Been all over Europe, been in South America a little bit, but Thailand's coming up and we're excited about that.
Great. Well, enjoy that trip. I'm sure it's going to be an awesome one. I've been to that part of Asia myself before, and it's a beautiful country. So
good.
Well, what are outside of the ways that you've already provided for our audience to connect with you, what might be another one or two ways that folks can connect with you to learn more about what you're up to?
Yeah, I'm most active on LinkedIn. So you can look me up, Justin Moy. I'm also President's Club investor, a little trophy by the name. So that emoji tends to stand out to people. Just follow me, connect with me. I'm really active on there. I post a ton. I post a little snippet. I'm sure you'll see some snippets of this podcast on there, and you'll see a lot of the stuff we're working on. That's the most active way for me. And then on my profile, you can find all my info, and everything's right there for you. So head to LinkedIn. I know a lot of sales guys and girls are on there anyways. The President's Club investor, Justin Moy. You'll find me.
Justin, I really appreciate your time, and thank you for being on the Freedom Point podcast today.
It's awesome, man. Thanks so much for having me. This was great.
And listening audience, thank you again for jumping into another episode of the Freedom Point Real Estate Podcast. Look forward to catching you on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.